Hi, this is Kevin Hrdlicka, a member of Savant's Investment Committee and manager of the Investment Services team, here with a review of the markets during the first quarter of 2015. For stocks, 2015 turned over a new leaf as international stocks returned more than U.S. stocks. This was a change from last year when the U.S. stock market had higher returns. Global REITs continued their strong performance from 2014. Bonds around the world produced positive returns in aggregate, with especially strong returns from non-U.S. bonds. U.S. economic reports in the first quarter of 2015 were on the weaker side compared to previous quarters. Although it was a more modest quarter, the job market overall remained strong with unemployment at a more normal level of 5.5%. Inflation remains well below the Federal Reserve's inflation target, with Treasury yields remaining low as well. The beginning of the year was full of news from Europe. The Swiss National Bank removed its peg from the euro, causing the Swiss franc to surge 40% against the euro, which is an incredible move in the currency markets. The European Central Bank began quantitative easing to help stimulate the eurozone economies. Markets struggled in advance of the FOMC meeting minutes being released, where the Federal Reserve changed its language on interest rates. Stocks rallied after the release of the FOMC minutes and closed the quarter close to its highs for the year. U.S. large stocks were modestly positive for the quarter. Small caps had the best performance, up 4.3%. Value stocks again underperformed growth stocks among both large and small segments. Over the past 10 years, stocks have had high single-digit performance despite the financial crisis in 2008. International developed stocks surged in the first quarter. Within those markets, small caps outperformed large cap stocks. Returns would have been even higher, but the U.S. dollar appreciated significantly against other major currencies, which has a negative effect on returns for U.S. investors. Emerging market stocks, which includes countries like China and Mexico, had more modest returns than developed international stocks, but were higher than in the United States. In other areas of emerging markets, frontier markets, which are the emerging markets, performance was down for the quarter. Over the past year, the strong U.S. dollar has had a negative impact on returns. Next, let's look at bonds. I mentioned that the Federal Reserve changed some of its language in regards to potentially raising interest rates in the future. This caused a lot of movement in interest rates, but at the end of the quarter, bonds were positive as interest rates declined. Foreign bonds that have their currency hedged had the strongest bond returns in the quarter, and have had very strong long-term returns. Believe it or not, some foreign bonds actually have negative interest rates, meaning that borrowers are actually being paid to take on debt. In the alternative asset classes, global REITs surpassed the broad equity markets for the quarter. On the other hand, commodities were again broadly negative for the quarter. Similar to 2014, volatile oil prices were a very big culprit. Next, let's look at the asset class returns together. The portfolios on this slide illustrate the hypothetical performance of different global stock-bond mixes of indexes. The hypothetical investor with 30% stocks and 70% bonds would have earned about 1.2%, while a portfolio of 100% stocks earned 2.3%. The one-year return is even more pronounced, with stronger returns for heavier stock allocations. Broadly diversified portfolios consisting of stocks and bonds outperformed the S&P 500 during the quarter. It's a good reminder that no asset class will consistently be a leader or a laggard from quarter to quarter or year to year. In other words, market leadership is always changing, and it can happen at any time without notice. I also wanted to take a minute to talk about some recent changes to both the stock and bond allocations in the portfolios. For bonds, we reduced our TIPS allocation. For stocks, we increased our international stock allocation. I'll go into a little more detail for each on the next slides. I mentioned that the TIPS allocation was reduced, and there are a couple reasons. TIPS, which stands for Treasury Inflation Protected Securities, tend to rise in value when inflation is rising. The current inflation estimates lower the TIPS expected return. Also, we added to international bonds. International bonds are actually the largest asset class in the world and provide bond investors more diversification benefits because it includes bond returns from many other countries besides just the United States. On the equity side, we increased our international stock allocation. Valuations are low for international stocks. and there is a very strong relationship with low valuations and higher long-term returns. Plus, like with international bonds, there are diversification benefits because U.S. stocks and international stocks don't move in lockstep. That wraps up the first quarter of 2015. Thanks for listening.